Good evening, everybody. Thank you so much for joining us this evening. In light of the new budget, this is an appropriate time to review the Indian and Australian income tax returns. And we hope that you can make the most out of these sessions. And we have a lot of interest for this webinar. I will begin by discussing the sale of property under the new budget. Over the next 20 minutes, I will provide an overview detailing the basic process and highlighting how the new and the existing provisions impact property transactions. Then we have 10 minutes for Q&A. We will extend it if there are a lot of questions. And please add your questions to the chat board and we will address them during Q&A sessions at the end. At the outset, we have a disclaimer. This presentation should not be considered as tax advice. Please consult your tax agents and lawyers before proceeding further. And we are sharing this information for everybody's benefit. Before I begin, I would like to give you a little bit of a context about Nobilis. Nobilis is started in 2016. And out of my own frustration, being a chartered accountant and a CPA Australia, myself and most of my capabilities on the international taxation side, and I struggled to get the funds to Australia, and there is no set process, there is no flow charts, there is no clear process, and our Indian chartered accountants don't understand Australian tax implications for Australian citizens and permanent residents, and Aussie accountants don't understand what's happening in India. So that's a perfect scenario where I thought I have understood this process by learning about it. Then I thought it could help others in the similar situation. Here we go. After 9 years of struggle from my team here in Sydney and Bangalore, and we have reached this point where we could advise our clients to save taxes and be compliant at the same time. Um, you may see the ultimate objective is to bring funds from India to Australian bank account after selling the Indian property. How do we do it? We have few hurdles to cross before reaching that happy moment of having funds in our Australian bank account. Let us start with basic questions. Should you disclose an Indian property sale in Australian tax return? Let us see, who has to disclose, why do they need to disclose, and what needs to be disclosed. I understand and really sympathize that many individuals may not include certain details due to the lack of clarity and confusion surrounding them. In some areas, it is not entirely clear, but when it comes to disclosing these informations and the capital gains in Australian tax return, it is essential to adhere to the Australian tax law. And it can be challenging to accept the fact that you have already paid taxes in India on these capital gains and haven't brought those funds to Australia. However, Australian tax law is very clear on this matter. It must be included in your Australian ITR. At our firm, we have been assisting our clients in properly disclosing this information and utilizing various tax planning strategies to manage and meet the required tax obligations. It provides a peace of mind, knowing that you are doing the right thing and avoiding penalties. And And especially if ATO or the OSTRAC eventually conducts a data matching, and it is going to be much, much easier for you. Compliances in India has increased dramatically. ATO has already started sending notices for the Indian income not being included in the Australian tax returns. Just to recap, permanent residents and citizens needs to disclose their global income in their Australian tax returns, including the capital gain. And it is wrong to assume that if you don't bring funds to Australia, then I don't need to disclose it in the Australian return. You have to disclose it properly. Let us look at the question number 2, where the Indian financial year and the Australian financial year overlapping months. What does that mean? The financial year in Australia starts from 1st of July to 30th of June. But in India, the financial year starts from 1st of April to 31st of March. It is advisable not to sell your property in April, May, June because of the overlapping financial months. So, for example, if you sell it in April, then you have to wait for another 14 months to lodge your tax returns in India. However, which falls within that same financial year, then you have to lodge your Australian tax returns within 6 to 7 months, which is probably in August, right? So before filing Indian tax returns, you have to, pay your taxes in Australia. That can be really a difficult situation. And with our experience, it is better to sell in the month of December and January. It's good, right? We will, we have holidays during that time, and you also get like 3 months before the March financial year end to do all the compliances and get your refund as soon as possible. The next question, what we are looking at is not doing an Australian tax planning before the sale. Let me just give you a little bit more understanding here, and I'm going to connect that with the new budgetary provisions here. And an important aspect of our discussions will be the changes in capital gain transactions, right? So the holding period for a long-term capital gain has been adjusted to 24 months instead of 36 months. So it is more beneficial to have a long-term capital gains, which is more than 24 months, than the short-term capital gains, which is taxed at a higher rate. So the tax benefits of holding property longer is always helpful. Notably, the budget proposes a significant change with the introductions of uniform tax rate. The choice is now between flat rate of 12.5% without indexing, or the 20% with indexing, whatever is beneficial to the client. So don't have to panic there. So they have moved the amendment to make it easy for clients. It's worth noting the evolution of a tax policies concerning indexing. For example, Australia has removed the index in 1999. It took like 25 years for India to do the similar global practice. And it says the different priorities for the different countries. So these are still a proposal. It has not been passed in the parliament. I don't know when it is going to be passed in the parliament, but we are definitely going to have another webinar to, if there is any changes with respect to sale of properties in India. So coming back to the 12.5% indexing point of view, there is a, if there is a smaller gain, the benefit of indexing, which is now proposed to be removed, could have been a more favorable. This change aims to simplify the tax structure, offering parity between residents and non-resident taxpayers, maintaining a significant tax saving, such as low rollover benefits. These benefits include investments in bonds and purchase of another property to save the capital gains. STT is for shares and mutual funds, and I'm not going to go in detail. However, there is some bit of an increase which has happened, and the exemption limit is mostly applicable to resident taxpayers, not us. So we will take it up some other time. Planning the Australian tax return beforehand will help you minimize the overall tax liability, both in India and Australia put together. As you are aware, such transactions can have significant tax implications both in India and Australia. I believe it is crucial for us to engage in a proactive tax planning before these sales occur to ensure you can maximize your savings. It is helpful in the case of investment properties, especially for the inherited properties. Tax planning is a powerful tool that can substantially reduce your tax liabilities in both in India and Australia. As we discussed earlier, as an um, Australian, you have to pay tax in Australia for the Indian sale of shares or of properties, irrespective of funds reaching Australia. By strategizing ahead of financial year, we can explore various lawful avenues to minimize the taxes you owe. And this might include the timing of sale, advantage of taking a dual tax exemptions or deductions, and other strategies tailored to your unique situations. It is important to note that our options to optimize your tax position significantly diminishes once the financial year is concluded and after the year end. And our ability to influence the outcome of the tax liability is very limited. We will primarily focus on the compliances with the ATO rather than tax saving strategies. Please reach out just six months before the planned sale so that you do the right things by following a tax planning strategies. Just to give an example on the tax planning strategies, right? So reinvesting in your funds, let us say 50 lakhs in bonds in India, does not attract any capital gains tax in India. And this option may be suggested by you by a chartered accountant in India who may not fully aware of an Australian tax rules. And this tax exemption is not recognized in Australia, and you will have to declare it in the Australian tax return and pay taxes on that. And we can assist you with our customized tax minimization strategies by which 60 to 80% of our clients end up not paying any taxes in Australia for the property sale. And the property sales in India needs to be disclosed correctly. In our tax advice report, we consider your tax liability, cash flow requirement to suggest four different options to choose from minimizing the overall tax. We also consider visa conditions, rules, date of permanent residency, citizenship, date of purchase to apply tax minimization strategies. The one other important factor is a lower withholding of tax. See, there is a TDS of 20% withholding is applicable on a sale of property, not 1% as highlighted by others. So 1% is for the resident and 20% for the non-resident. And this could be 12.5% after what? After the budget passed in the parliament. So which is not certain at this point of time. But please note whether you make a gain or loss, this 20% or a 12.5% is continue to apply to reduce that. In our experience, the overall tax liability is around 6-7%, but the withholding tax is 12.5%. You end up claiming refund at 8 months down the line. So to avoid that, to get more cash flow into Australian bank account, you can apply for lower withholding of tax. Usually it takes 6 to 8 weeks. So it is recommended to reach out as early as possible. Let's look at NRO account, PAN, KYC to transfer funds to Australia. These are basic documentations needed, and funds get stuck in India because of something simple like not having an NRO account. PAN, you need to update your current status. A lot of NRIs clients' PAN were deactivated recently, and the KYC is another important factor which you need to update with the bankers. And you sell a property, funds in the NRO account, and because of the KYCs, bank is holding your funds, right? That's the last outcome which we want, right? So just prepare yourself, make sure that you have updated everything. And one other thing is about the previous ITRs. If you have any income in India, which is above a threshold limit, please lodge your tax returns in India. Make sure that those compliances are in place so that you can sell your property at without any hassles. So preparation to sell your property is something which um, very important, and we could help you in every step when we do a tax minimization strategy. How much can we transfer? This is a common mistakes clients makes, that they think that $250,000 is a limit for us as being an Australian citizens and permanent residents. And our limits are 1 million US dollars. That means 1.3 million Australian dollars. So that without much documentation. So that is something which you need to know. So once your funds hits an NRO account, the bank insists on 15 CB, which is a chartered accountant certificate, to make sure that funds have gone through the tax provisions and good to go out of India. So these are very simple process. However, all documents needs to be verified. Your capital gains needs to be computed, and you must pay a tax on the entire sum, whatever is due in India. Unless that happens, the banks will not transfer your funds out of Indian bank account to an Australian bank account. I need to I need to give you a little bit of information here. There is a bit of a misconception that money has to go to invariably the funds will go to NRO account after sale of property. So you need not have to transfer to the NRE account before transferring to Australia. From an NRO account, you can directly transfer it to Australian bank account, and we can facilitate that part. And having an understanding with the banks and preferred banks, especially those banks can offer a client service support managers. So, which is much easier to interact with them and get the funds out of Indian banks. Here is a little bit of a homework for you. So just compiled a to-do list, what you need to be aware of in preparation to sale of properties. What do you need to do in Australia? Disclose global income in your Australian tax return, even though it is below threshold limits in India, right? Even $1 income in India needs to be disclosed in the Australian tax return. Let us be very clear on that part. And there's a clause number 20 in the Australian ITR, which says, do you have any assets outside Australia more than $50,000? It may be a property, it may be financial assets. Make sure that you tick that box so that ATO is aware that you have properties outside Australia. So if you don't do that, then when you sell your property, then you start disclosing a CGT, then there will be a mismatch there. And the second important part is about what you need to do in India. So as we discussed earlier, you can't have a savings bank account. you need to have an NRO account. Any buyer who is going to give you your funds, he needs to give it to you in NRO account. Because if you have a savings account, then the $250,000 limit would apply, and there is a mismatch with your PAN, your bank, and the how much you can repatriate the funds. PAN needs to be updated. IT portals needs to be looked into. Just look for any kind of notices or any old items pending in your income tax returns. Log into the portal and go ahead and check once and pay all the taxes. Whatever is a shortfall, make sure that you are ready for selling a property and repatriating the funds. Linking PAN and Aadhaar is another thing, and Aadhaar is not required for us as an Australian citizens. However, if you already have it, there's no harm in linking both of them. And always compute a taxes from the new regime to the old regime and compare it and see what is favorable for you for your own situation. That is where you will end up easily save thousands of dollars and making sure that you are and tax compliant as well. So finally, the good news is here that your funds has come to the Australian bank account. You know what you can do with it, and happy to help you with anything which you need from us after the funds have comes to the bank account here. And these are the services which we offer. And we have a network of professionals who can help you with any Indian property purchases or assist in selling and repatriating the funds to your Australian bank account. You will get high quality advice from us on time every time. And we also have a network within our client base, who are looking to buy Indian properties. And if you're looking for a buyer for your Indian properties, we can certainly assist you with that. Alternatively, if you have already found a buyer, we can help you with the sale and repatriation process. Best to reach out to us as early as possible, so that you are well prepared. All our partners have a good understanding of the requirements of Australian permanent residents and citizens selling properties in India, and you will be in safe hands. And our vision is to offer a one-stop solution to sell your Indian properties and bring funds here and build your real estate investment portfolio in Australia. We offer a peace of mind with a lot of hand-holding from our Indian team and value for service. This will reduce uncertainties in this process, and your funds are going to come to your Australian bank account as soon as possible. Thanks for attending this webinar, and good night to all. Thank you.